Namaskar. Welcome to a special video on the Union Budget 26-27. Finance Minister Nirmala Sitharaman is going to present her ninth budget, which is a record in itself. And the next year, if she continue to do so, she will be the longest one, along with the late Prime Minister Morarji Desai. So what will happen next year, that's a different question. But what is going to happen this year, we are going to talk to three economists, and all the three economists are the female economists. So we have with us Rajani Sinha. She is a chief economist with CareEdge. We have with us Kanika Pasricha. She is Chief Economic Advisor with Union Bank of India. And we have with us Rumki Majumdar, economist with the Deloitte India. Welcome and thank you very much for giving your time. Rajni, let me start with you. What is your opening thought, remark about the current situation of economy?
Shishir, firstly, thank you very much for giving me this opportunity. Now coming to what's my thought just before the union budget, I would say overall, if we look at Indian economy, is doing decently well, especially in midst of all that's happening around us, the global turmoil, the threat that is there on goods exports specifically. In midst of all that, I think with the 7.4% GDP advance estimate that has come, and we are also expecting something closer at 7.5% for FY26. So I would say in terms of growth, things are looking good. In fact, if we look at the other parameters also, inflation is also down. And interestingly, our external sector, in spite of the threat, is doing okay, is faring fine. Goods exports definitely would get impacted. They have already got impacted by the higher tariff from US. Services exports are doing decently well in terms of overall current account deficit. We feel we'll still manage around 1% of GDP. So with the macroeconomic parameters looking decent, looking good, I think this is a good opportunity for the FM, for the government to look at some structural reforms, reforms that would help sustain the growth at these high levels. Because
Mhm.
if we are looking at this aspiration of becoming Viksit Bharat by 2047, we need to sustain growth at a high level of 8% or more continuously for the next to 25 years. So how do we do that? So I think they should now, this is the time to focus on some of those bigger issues, because otherwise, if you look at the near term stimulus, monetary stimulus has already been given, rate cuts
Mhm.
have happened. We have already had income tax cut, we have had GST cut. In the past, we have already given a corporate tax cut. So I think this is the time to move to more of structural issues. How do we ensure? Because for India, like I'll talk about one of the issues, and then maybe later I can take up
Yeah,
other
yeah.
issues. But
Mhm.
one of the big issues is that we have this huge demographic dividend, and and especially at a time when all other countries, developed countries, are aging, we have a large working age population. But this can also become a bane if we don't utilize this demographic dividend well. So I think the biggest thing that we need to look at is how do we create enough jobs?
Okay.
And if that's taken care of, that will also take care of household consumption, that will
Mhm.
take care of private investment, and rest of the things can fall in place. So I think the budget should focus on some of these bigger issues.
Okay. Kanika?
Thanks, Shishir. So, first of all, of course, very grateful for this opportunity and completely echo what Rajni has talked about as well. The economy is chugging along on a very positive pace, and we in banks or like the way RBI calls it, a Goldilocks moment, because that is what we say is high growth, low inflation. In specific, the kind of uncertain world that we are dealing in, where last year we got 50% tariff hike from the US. There was significant foreign investment outflows. There was underperformance across market asset classes, be it equities, be it bonds or FX. Everywhere we saw some underperformance compared to global peers. Despite that, the economy showed an uptick. That's a positive.
Mhm.
Now, even next year, the question then comes up, will we actually be able to achieve that Goldilocks or not, where high growth and low inflation model? I would say yes, there are drivers in place for a repeat of that Goldilocks in FY27.
Mm-hmm.
But in an uncertain world, it is difficult to commit to a certain framework.
Mm-hmm.
We must be on very, very close watch. And of course, compliments to our policymakers for doing that. So, why do we say that we may achieve like after a 7.4% growth number for the current year, which we
Mm-hmm.
think may be slightly higher? Even next year, the number is tracking around 7%. You may call it a slowdown, but in our view, this is normalization back to long-term growth in India of
Mm-hmm.
6.5 to 7% range. That's one. Second, what's driving this number is this whole expectation that there has been a cyclical recovery in demand and the
Mm-hmm.
momentum may continue. That is sustainability of impact of some of the reform measures that the government has taken via, like Rajni talked about, income tax cuts, GST cuts. There's been monetary easing, significant 125 basis points rate cut, liquidity easing measures, and also this whole expectations that the US India trade deal would eventually be struck. Despite that, our exporters have been able to diversify markets.
Okay.
All that creates a positive framework. Now, there's only one reform that we are looking for in the union budget as bankers. And I
Mm-hmm.
would say it's not just about, it's basically becoming a financial sector problem and needs to be solved on an urgent basis. As we were talking about before the podcast
Mm-hmm.
casually, it seems there are some reform measures which have been discussed many times in the past, but maybe
Mm-hmm.
the time has come for the government to hear us out. And that
Okay.
is on deposit tax rate cuts
Mm-hmm.
and trying to align that, or I would say instead of cuts, the alignment of tax rate on deposits, bank deposits, with that of equities, and
Mm-hmm.
maybe, equity funds, and maybe alignment of that with debt funds as well. To get
Okay.
some alignment, because today banks, which are witnessing very fast pace of credit growth,
Mm-hmm.
deposit growth is underperforming, creating a structural bottleneck of consistent upward pressure on cost of funds. And to
Okay.
achieve that Viksit Bharat goal, of course, we need jobs, but we also need low cost of capital that somewhere is not just linked to RBI repo rate cuts. They have done their job beautifully. But to
Mm-hmm.
transmit that to broader economy, you need deposits, and this whole shift in our household savings pattern, which is becoming too equity oriented, to
Mm-hmm.
have some more attraction of debt related products as well. Thank you.
Okay. Rumki, your opening remark, please.
Thank you so much, Shishir, for having me over here today. Um, I would, I think there is a lot of confidence that I come in with because if you remember last year, this is the time when we were making projections for the coming year, and all the numbers were around 6.1, 6.2. First two quarters, we are already at 8%. And that tells you that there is a lot of resilience in the economy. Despite all that we have seen through, the economy has stood its growth number. And I think in the third quarter, the high frequency numbers are also suggesting that it was a good quarter. So if 3 quarters are around 8, we can happily say that we probably have gone over the mark of 7.5% for this fiscal year. We are expecting growth around 7.5 to 7.8%. I wouldn't be surprised if it's higher. Um, and if you look at the timing of the budget, I think this is in the last 10 years, this is one budget where pretty much all parameters are fantastic.
Mm-hmm.
Look at current account, one of the lowest in a decade. Inflation, one of the lowest again in a decade. Growth, probably one of the highest that we have seen in again a decade. Fiscal deficit, yes, a little higher, but given the fact that we were at 9.2% in 5 years back, from there to bring it down to 4.4%, that tells you a commendable commitment of the government to bring down this fiscal deficit and give the confidence to the investors that yes, we are serious about our expenses. So clearly, the economic fundamentals are strong. Growth has been very resilient. And this is all amidst all the geopolitical uncertainties and trade uncertainties that we have seen. And I think it's not by chance because through the year, if you look back, the government has done a fantastic job, be it through tax exemption,
Mm-hmm.
be it through GST reforms, be it through the labor reforms and so many and monetary policies. All these have resulted in a huge support towards the demand, and hence we became the fourth largest economy. We also saw an S&P upgrade for the economy. So clearly, 25 we reached quite a few milestones. 26 is going to be equally challenging. We are seeing things turning around, and quite a lot might change after the what is happening at WEF. But given that uncertainty, I think now is the time the government should look at the supply side of the economy, where it should probably focus on MSMEs, which will probably address some of the job related issues. It should look at R&D, because now it is understood we need to move up the value chain. We really need to be up in the manufacturing, even in services. And all that can happen only when India spends on R&D. So that is the second. And I think the third is where I think some of the requirements to make ease of doing business better. And so single clear window, some of the legacy issues of infrastructure, these needs to be addressed in the budget. And I think and we probably will be doing far better even going forward.
Okay, thank you, Rajni. Thank you, Rumki. Rajni, let me come back to you. It is said that budget is not just a one-time exercise; it is a continuous process. I mean, throughout the year we have seen small budgets. Like if I can remember what Prime Minister had said once, that we will not have a full budget, but we will have a small budget throughout the year. So, do you think that everything should be announced in the budget, or should we wait for the action based on certain changes like geopolitical changes? That would be the right approach?
Absolutely, Shishir. In the budget, yes, we are expecting, we will get a sense of government finances for sure. What's the direction they are looking at? They have highlighted that this time they'll be focusing on how the debt trajectory is going to move. So we'll get a sense of that. Reforms, yes, broad reforms, we'll get an idea about that, and that's what the budgets are used for every year. But I agree with you, things are so volatile on the global front that once the budget is announced, it's not that we are done with it. I think the government will be flexible, and going forward as required, there will be further announcements, there will be reforms as required, and we've seen that in the last few years. So, if things worsen and they feel that, there is need for further support to, say, India's export sector, we may see something coming up later. Or something like land reforms. We've had labor reforms, but what about land reforms? Even if there's nothing major in the budget, we could see something coming up later during the year as things work out. So I'm quite optimistic that not just the budget, after that also we could see announcements or policy support as required. Because
Okay.
things are pretty uncertain on the global front. And right now, while things are looking good, we just discussed the macro fundamentals are all looking good, but it's really difficult to say going forward how things will play out. So we
Okay.
are also expecting GDP growth of 7% for FY27, which, like we discussed, it's a moderation, but still it's a very good number that we are still talking about. But if things worsen, and we don't know what else can come from US, so if things worsen, we need to be prepared, and I think government will respond as required.
Kanika, when we talk about the fiscal deficit number, of course, we are talking about 4.4% of GDP. But if I go by the April-November number, which is at present available and which is also key for what we call as for finalizing the budget estimate for the next fiscal, we have seen that 62% of the budget estimate has already been exhausted in these months, as against 52% what we had done last year. The tax revenue is down. Still, we are confident of meeting the fiscal deficit. How optimistic you are?
Actually, Shishir, we are quite optimistic. And in fact, this is like in line with the trends we have seen in the past few years as well, that this government has been committed towards fiscal consolidation. So just 2, 3 points there. First, even though 62% of the budget has been met in the April to November period, if you see the focus is more on CapEx, which is quality of spending. Now there are, so in the total spending, you have CapEx, then you have revenue expenditure, within which there are two sticky components, which is interest payments, and second is subsidies. There also the government is maintaining the momentum in line with trends. But excluding interest and subsidies, the component that's left out, there is a lot of space to normalize or consolidate there, not expand as much as budgeted in order to support meeting of the overall fiscal deficit target. Now, where I agree with you is specifically in November, October, November, and even post-November, because of implementation of GST tax rate cuts, the government is likely to suffer some fiscal, it's a fiscal hit, right? Even if they're giving a lower number, it's partly because of GST compensation cess, where they are discontinuing that from 1st of February. So it's a hit of revenue. And the other part is also because nominal GDP growth itself is coming down this year from around 10% last year, 9.8% last year, to only 8%. That's also leading to a hit on tax revenues. Apart from, of course, if there's an income tax rate cut, the number was budgeted at 13.5% growth. There is a GST tax rate cut. So, of course, tax revenues are lagging. But there will be leeways in our view to consolidate spending without affecting growth significantly, but still meet the fiscal deficit number. In fact, we think that next year, this is actually to focus on demand side measures via tax rate cuts and also balance it out with fiscal consolidation, even if the age-old or the trend of pushing for further CapEx continues. I think it's a good strategy used by the government, and that will be maintained next year, in our view, where they may actually consolidate, but by a lower amount to balance between consolidation and growth.
Okay, Rumki, the one big issue is about the CapEx. Of course, many of you are saying that CapEx is good, but there is an issue that till what level the government should continue putting money there. We are not seeing the kind of green shoots which we should expect from the private sector. So do you think that increasing CapEx again and again by a good margin is really a good economics?
See, it's a simple Keynesian economics. When private sector is not investing, the only way an economy can be boosted is by government spending, right? And at least the government has been extremely prudent in spending quality-wise and ensuring CapEx spending going on. So clearly, it's a economics where we know private spending is not happening, and this is not because the private sector doesn't have an appetite to invest. If you look at outward FDI, it is one of the highest. Clearly, our corporates are going outside and investing. So clearly, there's some level of uncertainty in the domestic market, which is probably preventing them from investing. Second, if you look at the capacity utilization, it's 75%, around 75.8%, which is high, but not high enough for anybody to reinvest. So that is second. Third is, I think, a bigger bottleneck is how this US-India trade relation evolves. I think once that notch, we cross over that hoop, that sentiment rush will result in a lot of investments. But there it is stuck because we understand that even though we want to trade diversify, but currently we have a huge dependent on the US, not for goods, by the way, for services. And we have a huge, and services accounts for 55% of the GDP. So we cannot just ignore saying services, if that goes down, then it may not hit us. It will hit the GDP, it will hit our urbanization growth trend as well. So clearly, the US-India trade relation becomes one of the critical hurdle that we need to cross, and we will see the private investment coming back up. So, but till then, the government will have to not just invest, but I think a lot more it can do. It can enable the ecosystem, environment in how they can bring in. And that's what I was talking about, ease of doing business, R&D spend. We have the lowest R&D spend. That's where you should bring in, and the government cannot shoulder that as well. Bring in the private sector, ensure that they have the ecosystem, that the cost of failure it will be high, but then let that be acknowledged and encouraged, right? So all these aspects have to be brought in, and then only we will see the private sector coming in. Till then, I think the government will have to shoulder it. And this is as simple as a Keynesian economics that we have all studied.
Thank you. Thank you, Rumki. As a student of economics, of course, it is just going back to the book and realize that what is needed at this moment. Rajni, one of
Right.
the critical issue at this moment is the consumption, especially in the urban area. Of course, we have seen pickup in the rural area, but urban area seems to be slightly on a stagnant side. Uh, what is the way out? What we can do now? We have done income tax reduction, we have done GST rate reduction, but the urban consumption is not taking that pace which we were expecting. Where is the issue?
So, Shishir, you're very right. That's something which is still not picking up the way it was anticipated to, given the cut in income tax, the GST rate cut. And in fact, if we go by RBI's survey, consumer sentiment survey, there also, while there has been an improvement in sentiments, but specifically for urban area, consumer sentiments are still not in the optimistic zone. So I would say, what now the government needs to focus on, the important aspect is as to what's happening to household income.
Mhm.
And that's where, what I was highlighting earlier, it's important, one, that there are enough jobs created, and also there is a meaningful increase in real wages that's happening. Because if you look at the urban situation, one sector which is a large employment generator is IT and ITS sector. And there, the hiring has got impacted in the last few years. If you talk to college campuses, they will tell you as to how much the hiring has been weak in the last few years compared to what it was earlier. And
Mhm.
one big reason for that has been lower hiring by this sector. So even though, our services exports are still doing relatively better, but the point is with whatever is happening around us and with the kind of movement that's happening towards AI and automation, we are seeing an impact on job growth. And not just on IT, ITS, but broadly, what should we do to ensure that there's more job creation? It could be other sectors also, in services, healthcare, financial sector, they also have huge scope of generating employment. So I think what the now the real issue is as to what the government does to create more jobs, to ensure that real wages are growing, so that household income grows, which gives them the confidence to keep spending. Because a rate cut, income tax rate cut or GST rate cut, definitely that's a boost to sentiments, and that does lead to a bump in consumption. But that sustained consumption will happen when people have that optimism that they are going to get the jobs are available, their wages are going to keep growing. Only then will consumers spend confidently. So I think that's what is the need of the hour.
In fact, Rajni, I mean, I just want to, before going to Kanika, I mean, I was having two figures, one from the IT sector and one from a public sector bank. Kanika, since you belong to public sector bank, so I was talking to one of the CEO, and he said that during 25, 26, we have maintained that level. There is no fresh increment in that. And that is something which really put me a question that why? And he said, since we are moving to more and more digital lending, digital systems, so we do not need more and more people. So, Kanika, now my question to you is that we are talking about how to create job. But one of the things which is related with the banking sector, and you talked about availability of cheaper credit also. But one of the problems that deposit is not growing at the pace which should meet what the credit requirement is there. How to do that?
I would say, Shishir, there are two, three factors there to look at. But even before commenting on deposits, let's also understand one more aspect. Retail deposits, as Rajni was also mentioning about savings, household income trends, retail deposits will be dependent upon trends in retail savings. And we have seen a shift there in the past few years away from banks towards, of course,
Equity.
mutual funds, equity, and even insurance, pension
Hmm,
funds,
hmm, hmm.
right? So that is a structural shift in the savings pattern. Now, that's also because the effective, after adjusting for tax rates, the effective return on a bank deposit is way lower than the long-term effective rate that you see in an equity, even on a debt mutual fund, even on an NPS or a PPF, small savings deposit, anything that you talk about. So there is a structural distortion there in terms of the tax uh, levels defined for a bank deposit compared to what you define for an equity or a debt mutual fund. That needs to be corrected to some extent. That's one. Second, but as an economy progresses, the households tend to shift towards riskier assets in their savings profile.
Mm.
What we are just trying to do is slow the process of shift in the savings profile from debt towards equity. That's the second point. Third, given we are just trying to so it's happened very swiftly, like you were talking about that today everything is digital. Post COVID, when everything is digital, a banker today has no control even on liquidity.
Mm.
So one is on the lending side, the other is on the deposit side as well. If UPI can happen, even overnight, you can see a very sharp offtake of deposits moving out from one bank to the other bank, and you fall short on liquidity. So,
Mhm.
from the same perspective, today bankers also need to learn that, of course, when you have greater digital means of investment, which
Mhm.
is why households have been so swift to move away from deposits towards market-linked investment instruments. Similarly,
Mhm.
bankers also need to shift their funding profile away from deposits to slowly and steadily towards borrowings. Now, they have
Okay.
done that in a mature economy. That does happen, but maybe the pace needs to speeden up. The acceptance and of course the strength of our corporate bond market needs to be higher. The depth needs to be stronger, higher, deeper, in order to ensure that we have greater sources, we have greater avenues for funding profile for banks, because it's easier said than done. When
Okay.
we say our Viksit Bharat aim, it's 13 to 15% credit growth is what is being talked about. 11 to 11.5% nominal GDP growth that's being talked about. But you need to fund that credit growth out of deposits, and that needs to be looked at very carefully. Thanks.
Okay. Now, Rumki, final word. What will be the big message of this budget?
I think the government is is all supportive of growth. It has probably fired all its gun on the demand side. So this message, I think it will be more on supply side. So I think they will go big on MSMEs, growth in tier two, tier three cities. That's where the potential lies.
Mhm.
And I think I mean I hope that they do go for R&D, because I think now it's time we move up our game in be it in manufacturing, be it services. We know we have to up our game in semiconductors, in EVs, in space, in defense, and all these are extremely capital intensive and extremely innovation centric sectors. So I think the message will be clear. We need to be self-reliant in at least where it matters. We need to build our own infrastructure and all this, and we need investments. And as mentioned, we also need foreign investors to come in, and all these small pieces will bring in that confidence will give confidence to the investors. And I think a lot of countries, in fact, it's a time when India actually emerges as a very strong investment destination, because even European nations are now looking towards where else they can do business, and India emerges as a very strong destination as an investment. So this is the time they need to send out that message that we are going high, we are thinking high. So and that's the message I think the budget will try to communicate.
Thank you. Thank you very much. That's all we have time with us. And I'm sure that this message we will hear on February 1 when another lady, Madam Finance Minister, will present her ninth budget. Thank you, Rajni. Thank you, Kanika. And thank you, Rumki, for talking to us.
Thank you so much. Bye.
Thank you.
Thank
Thank you.
you. Thanks a lot.